What is up, YouTube? This is Profit Day Trader here, and today we're going to go over the three main order types that you can use in the stock market. Now, there's definitely more than three, but these are the three most common and the three that are good for beginners to learn. So the three main types are market orders, limit orders, stop loss. So we're going to go over all three. We're going to go over them very slowly. This is a beginner series, so it's meant for people that don't understand anything about the stock market or who understand a little bit and is trying to learn a little bit deeper. So if you're a little more advanced, this might be the video for you, but you still could probably learn something. But I understand if it's a little bit slower, it might be a little hard to sit here and watch. But for beginners, we're going to go over this very carefully. My goal is to make sure you fully understand this. This channel's focused completely around learning stocks, learning programs, learning Thinkorswim, and other suggestions that you guys leave in the comments. So if you're interested in learning the stock market, consider subscribing to this channel. It really means a lot to me. Everybody that has subscribed, I really appreciate it. Thank you so much. It really means a lot. I'm really trying to build this community, and it really motivates me when I see people subscribing and liking these videos. So yeah, let's just dive in. So the first one we're going to go over is market order. Okay, so number one is our market order. Now, market order is, for day trading, in my opinion, the most popular. It's not necessarily the most efficient, but it keeps things smooth, especially in the beginning when you're not as confident in your trades. Market order is going to be your best bet. Now, if this looks confusing, don't worry. It's always confusing at first. Something's going to take a little bit of time. So I'm going to explain it to you as best I can. Of course, the best way is practice, just getting into trading, trade as much as you can. But I'm going to try to explain this as best I can. Market order is very simple. I don't think it's overcomplicated, but if you are struggling with it, again, you can watch this video over a couple times, or if you start live trading, it will make a little more sense. Okay, so market order. What a market order is. Now, first off, to understand, market orders can only be placed during active hours in the stock market from 9:30 a.m. to 4 p.m. Eastern time. So you cannot place market orders pre-market or after market. So market orders are only going to be during live trading. So what a market order is you're telling the program, I want to purchase this as quick as possible at the lowest price available that will get me filled instantly. So it's not the lowest price necessarily that people are looking to buy, but the lowest price that'll get you filled instantly. Market orders almost have 100% fill rate. Unless you're doing tens of thousands of shares, hundreds of thousands, you're not gonna have any issues getting your orders filled. So a market order is very important as far as efficiency, as far as keeping track of the flow of the day. Because if you're dealing with other stuff, we'll explain the other segments, but I'll explain to you why market order is the most efficient. You're losing a little bit of money doing it, but I think overall, in my opinion, I think for day trading, it's the best option that you can have. Okay, so a market order is, if I'm, let's just say, want 100 shares of, we'll just say GameStop, which is GME, because GameStop's seems really popular right now. Say I want to buy 100 shares of GameStop. Well, out of the three that I showed you, well, the third one's a little bit, that's necessary for all trades, but I'll show you that later. But out of market and a limit order, market order is going to tell the computer, I want to buy 100 shares immediately. Well, if you look over here, again, if you're confused by any of these terms, don't worry, we're going to go through it. You have the ask price and you have the bid price. So what the ask price is, this is the cheapest somebody's willing to sell. So somebody out there, we don't know who, is willing to sell. They say, okay, I have, they might have more or less, doesn't, it's not super important, but they're saying, I have 100 shares and I'm willing to sell all 100 shares for $10, let's just say. So a market order, this 100 shares is going to buy it at this price here. So you're going to be buying 100 shares at $10. Now it can move up, it can move down, depending, because it moves very quickly. So, but remember, when you go to hit buy a market order, you're buying this price. You're not buying the bid. Now the bid is somebody out there saying, okay, this is the highest I'm willing to buy. Let's say 100 shares of GameStop. I only want to pay $9.97. I'm not paying $10. I want to wait till it hits $9.97. Now you might look, okay, what's the difference of 3 cents? Well, if you're trading $100, 100 shares, not much. But when you're trading tens of thousands of shares, that 3 cents can be hundreds of dollars right away. So that's why a lot of people will go, no, they have their set price. This is the most I'm willing to pay for it. And the difference between this here and here is called the spread. Now the spread, again, is these two prices here. Because at the current moment, there is nobody willing to sell at these two or buy at these two. So that's what creates the spread. Now again, when you go to hit market order, you're not buying. A lot of people think they're going in at the bid. This is what people want to buy it at, but you're not. You're actually buying it at the ask price. So market order is you're coming in, you're saying, I want it right away. I want a guaranteed fill. I'll come in here, I'll buy it for $10. That's what the market order is. The bid price, you are not going to, you could get it for $9.97. If you go to hit the button and the price happens to drop 3 cents, you might get filled at $9.97. But you're telling it at that moment, when you look at this, you're buying this price with the market order. You're giving up, essentially, you're giving up 2-3 cents immediately as soon as you purchase that order. So you understand that when you do a market order, you're instantly in the negative immediately. Now, why do I say that? Because when I'm right now focusing on buying. So this is a buy order. So that's buying 100 shares. It's going to tell it to buy it at $10 immediately. So now we're going to focus on a sell market order. We're just going to say sell. Now here's where the issue is. So when you go to buy 100 shares of market order, you're buying it at the ask price. But when you go to sell, so say you bought 100 shares, $10. And you're like, oh crap, you know what? I don't like this trade. I want to sell it immediately. I want to sell 100 shares at market order. Well, again, it flips. So you're not going to be selling. If you're going to sell, you're not selling at the ask price. You're going to be selling, because this is telling it wants to be right away. You're going to be selling it at $9.97. You're selling it immediately at the bid price because the computer is trying to get, at a market order, the computer's trying to get rid of these shares right away. So when you buy, you're buying the ask. When you sell the bid with a market order. So if you bought 100 shares, sold 100 shares, you lost 3 cents. Even though it doesn't make any sense, that's the way it works because you're giving up the spread in order for the convenience of getting filled immediately. So understand that. People don't realize that. They lose a lot of money not realizing that. They think when it's over here, oh, it's $9.97, I'll hit market, I'll buy it at $9.97. No, you're purchasing at the ask price. The ask price is $10. So understand that. It's very, very, very important. And as soon as you sell, you're not selling it at $10. The price might show $10, but you're selling it to the highest bidder, to the person that's willing to pay the most in that immediate moment. So your shares are going right here. So just understand that. That's how market orders work. They're good for the flow of things, and you'll see why, because I'm going to go over limit orders in just a second, but you'll see the problems that limit orders have that I think don't. There's definitely pros and cons, but I think the cons outweigh the pros. So up next is going to be understanding the limit order. Okay, so next up is our limit order. Now, limit order uses the same concept, but it's a little bit different. So limit order is you're telling the computer specifically the price that you want to buy and you want to sell at. So it's not exactly opposite of market order, but it's kind of usually typically you're trying to get it at a cheaper price or sell it at a higher price. So as I said, with market order, when you go to buy, you're buying the ask, and when you go to sell, you're selling the bid. Well, what limit order is, you tell the computer very specifically what you want. So I'm going to go over here and say, I want to buy 100 shares of GameStop at a limit order. Well, I can look at this table here and be like, okay, you know what? I like $9.97. $9.97 seems like to be a good price for me. I want to put a limit order in. I'm going to join these guys. I'm going to join the bid. I want 100 shares. I also want it at $9.97. So the issue with that is one of these guys is going to have to budge either. So when you put your order at $9.97, you're not going to get filled right away. I mean, typically you do because it works a lot faster unless you're in a slower stock. But you're in a quicker stock, it usually moves pretty quick. But you're going to say, okay, I want 100 shares at $9.97. Two issues with this. So one is you have to wait either for somebody that's on the limit orders on the sell side. They're going to either come down and like, you know what, I'll sell it at $9.97. So there's going to be somewhere out there that's going to say, okay, I'll put a limit order in, sell $9.97. And they'll feed into your shares. Well, the thing is, you have to wait. You might be behind a lot of people at this price as well. So you might put 100 shares in. There could be thousands of shares waiting to be filled at that price. So you might be in line to go to buy that price, and then all of a sudden 1,000 go by. All of a sudden there's nobody left. There's nobody left to buy it anymore, to sell it anymore. And all of a sudden this price might move up. It might go up to $9.98, $9.99, and you're sitting here now at $9.97, waiting for the 100 shares to be filled. So just understand what the risk of the limit order is. You're not guaranteed to fill your shares. So you're not guaranteed to own 100 shares. And sometimes even worse is it might do a partial fill, which is even worse sometimes because now it's confusing. You might say, I want 100 shares, but there was only 25 people selling that shares, only 25 shares selling. So they might sell in 25 shares. You might only own 25 now, and this price might go up or down. And now you're sitting there with only a partial fill. You might only have 25 shares. Now, the benefit is, of course, you're getting the price. You're saving 3 cents. When you go do a market order, you lost 3 cents immediately. But with limit order, you don't. So when you fill it, you fill the exact price that you want. But sometimes the stocks can move on you. They can, I mean, if you're only dealing with 100 shares, you probably wouldn't have this issue. If we start scaling up thousands, tens of thousands of shares, limit orders can be tricky to get filled. So just understand that you're not compromising the price, but you're compromising the shares. And usually you don't really get filled all the way. And again, I think it's confusing. It's gonna take a little time to learn this. So don't worry. It's a learning process. It might sound more confusing at first, but it won't. But after a while, it'll get better, I promise. So, and again, and vice versa for the limit when you go to sell. So you look at this chart here, you're like, okay, right now, the highest person wants to pay is $9.97. The lowest somebody wants to sell is $10. Well, I think this price is going to get $10. I want $10 as well. So I'm going to sell my 100 shares. I want to sell it at $10 too. So you're going to join these guys. You're going to join the people at the ask and say, now the people that are buying market orders are going to start buying your shares, or the people that are putting limit orders in are going to also join the $10 buying it. Now, again, with limit order, you don't have to join the ask or the bid. I can come over here and say, okay, there's a lot of people here trying to buy it at 10. I want to get my order filled quickly. I'll come over here. I'll put my limit order here. I'll put it at $9.99. And that actually changes. That actually closes the spread. So that's how the spread changes throughout the day. So people, okay, not a lot of people are buying it at 10, but maybe I'll get lucky. I'll get filled $9.99. I'll get ahead of these guys. So that's the way the prices go up and down. Now, that's pretty much, there's other types of limit orders. I understand if you're watching this a little more advanced, you understand there's a lot more to limit orders, but that's the basis of market and limit orders. Now, with both of these, I don't care which one you choose, when we're going to, on our third segment, is going to be, you always, always, always should use a stop loss. Stop loss is the most important order. Burn it in your brain is the most important thing you're going to learn. It is what is going to make or break you as a trader in this business. So we're going to go over it now. Okay, so last and most importantly is your stop loss order. Now, please, please, please understand this. If you're a beginner, don't even know that there's any other way. To understand this is second nature. This is the most important thing. This will make or break you as a trader. And I know there's a lot of controversy with this because you hear a lot of people, oh, I have a mental stop loss. No, you put in a hard stop loss always. Whenever you go to buy something, whenever you buy a share, or if you short stocks, I'm sure if you're beginner level, you're not shorting stocks just yet. But if you buy shares, you put your stop loss in immediately. Always, because I'm telling you, I've done it. I thought I was better than it, and I'm not. Because I sit here and I'd be like, oh, well, it's going to come back up. It's going to come back up. Sometimes it does. Sometimes you were right. But when you're wrong bad. So I'm going to go over what stop loss is in just a second, but I want you to understand how important this actually is. This literally could make or break your entire trading account. You can lose, I've seen people lose a lot of money because they didn't put in this one little line right here with one little order. So just understand that if you think you're better than it, if you think you're smarter than it, you're not. I thought I was too. Don't get me wrong. This isn't me, this has come from experience. I've lost a lot of money all because I didn't put in this one little thing here. So understand this is the most important thing that you will ever do in the stock market world. Okay. So whether you did your market order or your limit order, that's personal preference. You understand now what they mean, how to purchase the stock. Great. Now you own 100 shares, and you got it at $10 a share. So you own, congratulations, you have a lot of money, you have $10,000 worth of GameStop stock. It's hard to say. All right, so you have 100 shares at $10. So what is a stop loss? So a stop loss is you're going to tell the computer, okay, I have these 100 shares now at $10 a share. Now, I don't want to lose too much money in this. So immediately, you're automatically going to have a sell order in the program that's not going to execute unless it hits a certain price. So it actually triggers at a certain price. So the reason why this is so important is because this is risk management. This is, okay, it's at $10. I really thought it was going to go to $10.50. But for some reason or another, right now it's at, $9.95. Well, what a lot of people do is they wait, or they just wait to see what's going to happen. That's fine. You're going to watch the stock, of course, but you want to have, this is your safety net. This is going to tell the computer, I'm not taking less than $9.90 back for my 100 shares. I'm only willing to risk $100 on this entire trade. If you put this in, you can't lose more than $100. Now, I mean, that's not 100% true. Technically, you can skip it a little bit, or you can have some slippage. Don't worry about those little terms if they're scaring you, but you're going to be very close to $9.90. 99 out of 100 times you get filled at the price that you put it at. So what a stop loss is, this stock can go all day. If it's bounced around $10, $9.91, if it's just bouncing around like this, you're still going to own those 100 shares. You're going to have them. They're still yours. You own them. This goes up. You can have this for the rest of the day. Usually stop loss is good for that active trading day. At 4 o'clock, the stop loss is going to be, unless you put in a good till canceled order, the stop loss is going to be no good for the next day. So be careful. If you're buying and holding stocks, these are good for day trading. They're not it's a little bit different for buying and holding stocks. So anyway, so this stock's going up, it's moving up, down, up, down, up, down. Well, for some reason you were wrong. You thought the stock was going to go to 10.50. It's not. All of a sudden the stock just crashes. For some reason now it's went all the way down. Now the price, it just dropped to $9.80. You were wrong. You thought wrong. It happens to all of us. It happens to me all the time. Don't worry about it. Well, what happened is when this line hit your stop loss is there. It's there forever. This line goes on the entire day. As soon as it hit this spot right here, the program sold your shares. You sold your 100 shares at your 990 stop loss. So you put the stop loss in, it hit the line, it triggered the stop loss, it sold your 100 shares as a limit order to somebody somewhere. So if you didn't have this in, this thing can go down forever, and you'll just keep losing money. See, this is where people get emotional. They think they're more worried about being right than making money. I'm more worried about making money. Okay, I bought it at 10, thought it was going to go up. I was wrong. Oh well, get over it. It happens. It's going to happen plenty of times to you. Don't worry. It's going to get used to it. Losing is part of this business. So, but as long as you have your stop loss in, I can't control if this goes up or down, but I can control how much money I'm willing to lose. So in this situation here, I was like, okay, you know what? I think this is a pretty good, my odds are in my favor here. I've been studying. I feel like good about this trade, but I'm only willing to risk $100 on this trade at most. This is the worst thing that can happen. So understand, do not let your ego get in the way, because it happens is because what's happening is, and it happens to me, I've done it, I've gotten all emotional. What happens here in a lot of situations, it comes here, it goes to 988, and then all of a sudden it just like takes off, and you're sitting here and you're like, see, this is why I don't put stop losses in. It's gonna happen. Don't get into hindsight trading. Hindsight trading will ruin your whole career. So understand, this is part of it too. It happens, but guess what? This is a lot better than it going like this and going down forever. And now you're sitting there holding the stock for days, weeks, hoping that it comes up, and it just never comes back up. I'm telling you, stop losses are the most important, and it will literally save your life. As I said, worst thing to happen is you lost $100, stock goes on, get over it. As soon as your stock sells, I wouldn't even look at the stock anymore. Just, okay, I lost that trade, get the next one. That's all you can do. So understand, stop loss is 100% risk management. I've seen people like, oh, I'll just put a mental stop loss. If it gets below 990, we're emotional creatures. I've done it. It gets to 990, I'm like, oh, it's gonna come back up. It's 985, oh, it's gonna come back up. That's at 970, oh, it's gotta come back up, right? No, it could go down for, I've held stocks for weeks and it keeps going down and it just never comes back up. So understand, this is here, it kicks out, your trade's over, you lost, get over it. Don't get an ego. Remember, we're here to make money. We're not here to have egos. So that is the 3 most common order types. Again, if you've gotten any value out of this video, please consider liking it. I put a lot of work into these videos. It really means a lot to me if you're here watching it. I really try to build this community. If you're interested in more content like this, consider subscribing. Thank you guys so much. I appreciate it. And I'll see you guys in the next one.